Hey everyone, I'm just one person hidden deep in the countryside, surrounded by silence, but I built BlockSonic to speak with the entire world. Here, you don't get noise. You get the pulse of Bitcoin every single day, distilled into pure, essential updates. No teams, no sponsors, no filters. Just me, a signal from the quietest place on Earth, bringing you the most important Bitcoin news before the world wakes up. With BlockSonic, you don't need to search for information. I research, I write, and I tell the story behind every headline. I do the digging. I chase the truth. All you have to do is listen. Today, the news revolves around a pressing question. Is Bitcoin's future at risk? As we delve into this topic, we'll explore how the weaker dollar has failed to ignite Bitcoin's potential and what this means for investors. We'll also discuss the recent surge of the Paxos gold token, which has reached record highs as investors seek safe havens amid market turmoil. On top of that, we have news from Signum's Bitcoin fund, enticing investors with a promising yield of over $65 million. In a world where crypto markets are in turmoil and major tokens face significant drops, we'll examine the latest from Metaplanet, which is raising an impressive $137.0 million to bolster its Bitcoin holdings while addressing its debt. Stay with us as we unravel these developments and more, providing clarity and insight into the ever-evolving landscape of cryptocurrency. Metaplanet's bold move, raising $137 million to expand its Bitcoin empire. This Tokyo-based Bitcoin treasury firm is on a mission, securing fresh capital through a strategic share issuance to conquer debt and acquire more Bitcoin. Imagine a company on the brink of transformation, poised to gather $137 million to not only alleviate its burdens, but also to intensify its Bitcoin acquisition strategy. This is the striking reality for Metaplanet, a Tokyo-based firm that stands at the intersection of opportunity and audacity in the world of cryptocurrency. You might wonder how they plan to conjure this capital. The answer lies in a carefully orchestrated sale of new shares and stock warrants targeting a select group of investors. This is not just a financial maneuver. It is a testament to their belief in Bitcoin's potential. By issuing 24,530,000 new common shares at 499 yen each, they are not only raising approximately 12,240,000,000 yen upfront, but also signaling their commitment to the future of sound money. Yet, the market reacted with skepticism as the company's shares closed at 456 yen, reflecting a 4% decline. This is where the narrative thickens. The underlying tension of short-term dilution concerns clashes with the long-term vision of Bitcoin's ascendance. What happens next is crucial. Will the investors see this as a strategic investment or a risky gamble? As we delve deeper, we find that this capital raise is structured as a third-party allotment, a calculated decision to place securities directly with specific investors rather than opening the floodgates to the general public. This approach reveals Metaplanet's strategic focus on fostering relationships with those who understand the intrinsic value of Bitcoin. Every new share is accompanied by the promise of stock acquisition rights, equating to nearly 16 million additional potential shares. With a fixed exercise price of 547 yen, the allure of these warrants is palpable. If exercised, they could generate up to 8,900,000,000 yen in additional proceeds, creating a path to financial empowerment and further Bitcoin accumulation. Now, let us pause for a moment. Of the upfront capital raised, 5,200,000,000 yen is earmarked for the partial repayment of existing debt. This act of financial prudence speaks volumes about Metaplanet's commitment to securing its foundation, even as it reaches for the stars. With approximately $280 million of debt still outstanding, the journey toward fiscal stability is fraught with challenges. But the story does not end there. Metaplanet currently holds 35,102 Bitcoin, making it the fourth largest Bitcoin holder among publicly traded companies. This remarkable position highlights the company's audacity and foresight. As they navigate the turbulent waters of the cryptocurrency market, one question lingers: will their strategy pay off in the long run? As we draw this narrative to a close, we invite you to reflect with us on the implications of this bold capital raise. What does it mean for the future of Metaplanet and the broader Bitcoin ecosystem? Join the conversation and share your thoughts as we explore the unfolding story of sound money and human action together. The hidden pressure. Majority of Bitcoin's value lies above $88,000. With most invested Bitcoin priced above current levels. Vulnerability looms if critical support fails. Imagine a vast ocean of wealth, yet the tide is pulling back. You might be surprised to learn that a staggering 63% of all Bitcoin investors find themselves under pressure, with their cost basis resting above $88,000. This revelation, drawn from on-chain data, is more than just a statistic. It unveils the precarious state of the largest cryptocurrency. Consider this. When investors bought their Bitcoin, they believed in a future where prices would soar. But now, the reality is stark. The invested wealth reflects the total value of capital deployed when the coins last moved on-chain, revealing a disheartening truth. The majority of capital entered the market at higher prices than where Bitcoin trades today. We can attribute this insight to a metric called the UTXO Realized Price Distribution, or URPD for short. Each bar on this chart tells a story. It shows the price levels at which Bitcoin last changed hands. As you look at it, you see a striking image. A significant portion of Bitcoin is trapped above $85,000, creating a potential minefield of selling pressure. The market has been stuck in a tight range between $80,000 and $90,000 since November. The URPD illustrates just how much capital sits underwater, with tens of billions of dollars languishing between $85,000 and $90,000. If the price dares to dip below $85,000, the implications could be severe, as investors scramble to limit their losses. Long-term holders, in fact, are already selling at the fastest rate seen in 6 months, a sign of the growing urgency. But that's not all. Picture a fragile bridge with little support. There is a concerning lack of supply between $70,000 and $80,000. Should the $80,000 level falter, which it last tested in November, a swift descent towards $70,000 could quickly follow, heightening the tension in the market. As we peer into February, the outlook is equally intriguing. Bitcoin seems poised to end January with little change, lacking the typical relief rally that often follows 3 months of declines. Historically, February has proven to be a strong month, averaging gains of around 13% according to data from CoinGlass. However, whether history will repeat itself hinges on how the market navigates the current landscape of underwater supply. Now, pause for a moment. Reflect with us on the intricate dance of human action within the markets. This situation invites you to ponder. What does it mean for the future of Bitcoin? The interplay of price, pressure, and potential is a story still unfolding. As you contemplate these insights, share your thoughts with us. What do you believe lies ahead for the Bitcoin landscape? If you believe in what we're doing and want to support BlockSonic's growth, just scan the QR code on the screen or copy the link in the description. Every contribution makes a difference and helps us keep delivering quality, independent, and up-to-date content for you. 3 weaker dollar fails to ignite Bitcoin's potential. Here's the truth. Gold and other hard assets are thriving amidst dollar weakness, yet Bitcoin remains stagnant as markets cling to its risk-sensitive nature. The recent decline of the dollar, while significant, has not sparked the typical Bitcoin rally you might expect. Our exploration today reveals why this phenomenon is not merely coincidental, but a deeper insight into the current economic landscape. Over the past year, the dollar index, which measures the strength of the dollar against a basket of other currencies, has plummeted by 10%. In stark contrast, Bitcoin has experienced a decline of 13% during the same period, according to data from our trusted sources. The CoinDesk 20 index, which tracks the largest digital assets, has fallen even further by 28%. What's different this time? The dollar's decline is being propelled more by fleeting sentiment and short-term capital flows, rather than any significant shifts in growth or monetary policy expectations. This is a critical point, as strategists from JP Morgan Private Bank illuminate. It's vital to understand that the recent drop in the dollar isn't tied to any changes in growth or monetary policy, explains Yuxuan Tang, the head of macro strategy in Asia at JP Morgan Private Bank. Interest rate differentials have actually become more favorable for the dollar since the beginning of this year. What we're witnessing now resembles last April, where the dollar is being sold off, mainly due to market flows and sentiment. The perspective from the bank suggests that this weakness may only be a temporary condition, akin to last year's fluctuations. They predict that as the world's largest economy gathers momentum, the dollar will ultimately find its footing again. This insight sheds light on why Bitcoin has not behaved as a conventional hedge against dollar weakness, while gold and other tangible assets have surged as the dollar falters. Bitcoin has remained trapped within a narrow trading range. This indicates that the cryptocurrency market does not perceive the dollar's decline as a lasting macroeconomic shift. Consequently, Bitcoin continues to trade more like a risk-sensitive asset rather than a reliable store of value. Without a significant shift in monetary policy expectations, merely a weak dollar is insufficient to galvanize new investments into the cryptocurrency markets. JP Morgan Private Bank further directs investors towards gold and emerging market opportunities as more immediate beneficiaries of dollar diversification, rather than Bitcoin. Until we see growth or interest rate dynamics take precedence over sentiment and flows in the currency markets, the largest cryptocurrency may continue to lag behind traditional macro hedges, even as the dollar stays soft. So, as we reflect on this unfolding narrative, we invite you to ponder this question. What does the future hold for Bitcoin in a world where dollar fluctuations are merely surface deep? Your thoughts could illuminate the conversation around the evolving landscape of cryptocurrencies. Bitcoin's dilemma. The struggle to compete with gold's allure. As Bitcoin faces pressure, the allure of gold rallies pulls attention away from the crypto market, leaving Bitcoin struggling amidst macroeconomic shifts. You may have noticed a subtle tension in the markets lately, one that many traders are grappling with. As Bitcoin lingers under pressure, gold's rally captures the spotlight. This dynamic begs the question, why is Bitcoin trailing behind gold and silver in this moment of market upheaval? Bitcoin, currently valued at $87,937.68, dipped below $88,500 recently. It briefly flirted with the $89,000 mark earlier in the session, extending what has been a tumultuous week for its price. Meanwhile, Ethereum, valued at $2,929.65, and other altcoins, like Solana and XRP, face deeper intraday losses, slipping between 2% and 4%. The crypto market struggled to gain ground, overshadowed by a stronger dollar and rising commodity prices. Commodities, particularly gold, have taken the lead in market attention. Gold recently held near record levels, surpassing $5,500 an ounce earlier this week, while silver and copper also remained elevated. What propels this strength in metals? It stems from earlier dollar weaknesses, geopolitical tensions, and a growing demand for assets considered safe havens amid government financial uncertainties. In a surprising twist, the dollar index recently experienced its largest single-day gain since November, driven by U.S. Treasury Secretary Scott Bessent's comments advocating for a strong dollar policy. This statement countered speculation that the government was comfortable with a prolonged dollar decline. The Federal Reserve's decision to keep interest rates unchanged after 3 cuts last year has also influenced market stability, as policymakers await clearer indications of cooling inflation before making further moves. Now, amid this backdrop, we see Bitcoin sidelined, struggling to keep pace with gold's ascent. Although Bitcoin has been framed as a safeguard against currency debasement, it finds itself trading approximately 30% below its peak from October, while metals and global equities flirt with record highs. Traders have noted a concerning trend. Bitcoin behaves more like a high beta risk asset than a reliable macro hedge. It reacts to fluctuations in the dollar and overall liquidity, rather than carving out an independent narrative. Alex Kupcikevich, the chief market analyst at FXEOS, highlighted a crucial observation. During a period last year, when the dollar weakened by 8%, Bitcoin soared over 50%. Yet, the recent 4% drop in the dollar index did not yield a similarly impressive response from Bitcoin. Instead, we witnessed a 30% jump in silver and a 15% rise in gold. As Bitcoin attempts to consolidate above $89,000, it faces significant resistance. The 50-day moving average reinforces this barrier, indicating a bearish sentiment in the market. Although Bitcoin has managed to maintain support around $85,000, trading about 1/3 below its recent highs raises concerns about its resilience. As the past week reinforced these patterns of crypto lagging behind the rally in metals, we now shift our gaze towards the upcoming megacap technology earnings reports. Will movements in equities, bonds, or currencies spark fresh cross-asset volatility? Until clarity emerges, Bitcoin seems trapped in a consolidation phase, holding on to key support levels but lacking the momentum to rejoin the broader market trades that dominate the economic landscape. So, here we are, standing at a crossroads in the financial narrative. As we reflect on this interplay between Bitcoin and gold, we invite you to ponder how these dynamics shape your understanding of sound money and its role in our lives. What is your take on Bitcoin's journey in this metallic shadow? Share your thoughts with us. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Surging oil prices, a dangerous signal for Bitcoin's future. Rising oil costs threaten inflation, complicating the Federal Reserve's ability to cut interest rates and jeopardizing Bitcoin's recovery. You may feel the winds of change swirling around Bitcoin, as it seems every week brings new challenges. First, we witness the meteoric rise of precious metals like gold and silver, draining capital from the crypto landscape. Now we face another looming crisis. Oil prices are beginning to surge, casting shadows over Bitcoin's potential resurgence. As you might have noticed, the price per barrel of West Texas Intermediate crude has jumped by 12% this month, reaching $64.30. This marks the highest price since September. Meanwhile, the international benchmark, Brent crude, is not far behind, climbing to $68.22. What do these rising prices mean for Bitcoin and its supporters? For those of you banking on a stable inflation environment and lower interest rates to fuel Bitcoin's ascent, this news is unsettling. Just consider the context. Bitcoin hit a peak above $126,000 in early October, only to tumble below $90,000 since then. The stakes are high. and the potential for a prolonged downturn feels palpable. You may be wondering why the increase in oil prices impacts us all so profoundly. The answer lies in the fundamental nature of our economy. When oil prices rise, the costs of goods and services across the board follow suit. Higher oil translates to pricier gasoline, which drives up transportation costs for everything you rely on: food deliveries, clothing, electronics. Ultimately, these increased costs trickle down to you, raising the overall price level in the economy. This scenario sets off a chain reaction. As prices rise, workers are compelled to demand higher wages to maintain their purchasing power, igniting a self-perpetuating cycle of wage increases and further price hikes. The implications are clear. Inflation becomes a tangible force that can't be ignored. The Federal Reserve understands this dynamic well. As it has stated, the pass-through effect of rising oil prices on inflation is both economically and statistically significant, occurring through direct channels and second-round effects. The Fed's approach to inflation, raising borrowing costs, could lead to a tightening of credit, as it did in 2022 when Bitcoin faced a staggering decline of 64%. As we navigate this complex landscape, it's critical to recognize the Fed's recent decisions. On one hand, we see a reluctance to cut rates quickly. On the other, rising oil could solidify their resolve against easing liquidity. This ambivalence could spell trouble for Bitcoin enthusiasts like you, who are hoping for a market rebound. Adding to this turbulent mix are geopolitical tensions that threaten to further inflame oil prices. Recent statements from former President Donald Trump about military maneuvers towards Iran, a major oil producer, could escalate the situation. Iran's response, vowing to retaliate fiercely, only heightens the stakes. As you consider these developments, the recent data from the U.S. Energy Information Administration reveals a decrease in oil inventories by 2.3 million barrels. This drop typically signals a demand that outpaces supply, forcing refineries to draw from their stocks. The implications for the economy, and consequently for Bitcoin, are profound. In this moment of uncertainty, we invite you to pause and reflect. How will these rising oil prices shape the future of Bitcoin and your financial choices? As we embrace the unfolding narrative of sound money and market dynamics, we encourage you to share your thoughts. What do you believe lies ahead for Bitcoin in the face of these challenges? Tech giants fueling AI growth. A goldmine for Bitcoin miners. As Meta reveals its ambitious capital spending plans for 2026, Bitcoin miners pivoting to AI could harvest significant rewards from this tech boom. Have you noticed how the world is buzzing with artificial intelligence? At the forefront, tech giants like Meta and Microsoft are making headlines with their monumental spending plans. What if we told you that Bitcoin miners could ride this wave of innovation and emerge as unexpected beneficiaries? As we dive into the latest earnings reports, Meta has projected capital expenditures for 2026 to be between $115 billion and $135 billion, surpassing the consensus estimate of $110 billion. This ambitious outlook underscores the relentless drive for AI integration in their growth strategy. But here's where it gets even more interesting. Bitcoin mining companies are transforming their business models to align with this AI frenzy. In the past year, those miners who have adapted their infrastructures to support AI operations have seen substantial gains. Can you imagine the potential profits awaiting them? Microsoft's Chief Executive Officer, Satya Nadella, has boldly stated, "We are only at the beginning phases of AI diffusion." This statement alone sends ripples through the industry, suggesting that we are just scratching the surface of what is possible. As big tech pours resources into AI, Bitcoin miners are not just standing by. They are reaping the rewards of this monumental shift. Consider the challenges facing Bitcoin miners, particularly after the last halving event, which have their rewards. Many have faced profit squeezes, increased competition, and rising energy costs. Yet, in the face of adversity, these miners have pivoted cleverly, repurposing their data centers to host AI and cloud computing operations. This strategic shift has allowed them to diversify their revenue streams and escape the brink of insolvency. Take Iron, for example. Recently, they announced a multi-year cloud services contract with Microsoft to support AI workloads using advanced NVIDIA chips. This not only marks a significant step towards high-performance computing, but also exemplifies how Bitcoin miners are adapting to the evolving landscape. As they embrace new opportunities, Iron stock has surged nearly 5% in a single day, contributing to an astonishing year-to-date gain of 47%. And it doesn't stop there. Cipher Mining has also made headlines by signing a deal with Amazon to provide 300 megawatts of capacity to Amazon Web Services. With such substantial infrastructure commitments, Bitcoin miners are firmly positioning themselves to capitalize on the AI boom. Meanwhile, Hut 8 is another player successfully riding the AI wave. With a year-to-date increase of 26% and a whopping 230% year-over-year, they illustrate the remarkable transformation occurring within the mining sector. But as we look ahead, we must ask ourselves, how sustainable is this optimism surrounding AI and cloud computing? The upcoming report from NVIDIA on February 25th will serve as a crucial litmus test for the industry's trajectory. So, as we contemplate this intersection of technology and finance, we invite you to reflect with us. How do you see the future of Bitcoin mining in the context of this AI revolution? Leave your thoughts below, and let's explore this fascinating journey together. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Gold surges past $5,400, while Bitcoin stalls. What does it mean for you? As gold enthusiasts flock to buy, Federal Reserve Chair Jerome Powell downplays the significance of soaring precious metal prices. Imagine standing on the precipice of a monumental shift in the market. You watch as gold, the age-old safe haven, surges above $5,400 per ounce, leaving Bitcoin, the shining promise of digital gold, in the dust. Isn't it fascinating how quickly fortunes can change? On Wednesday, a remarkable transformation unfolded as the price of gold skyrocketed 6%, marking a historic moment. This surge was not merely a flicker. It was a powerful testament to market dynamics, with gold's market capitalization hovering around the staggering figure of $40 trillion. But why now? What ignited this frenzy among gold enthusiasts? The catalyst was none other than Federal Reserve Chairman Jerome Powell, who spoke at a press conference following the central bank's decision to maintain its benchmark interest rate. When questioned about the swift rise in gold and silver prices, Powell advised caution. He urged not to misinterpret this rally as a broader macroeconomic signal. Don't take too much message into thought macroeconomically, he stated, asserting the Fed's credibility remained intact. Yet, gold bulls saw things differently. As gold gleamed brightly, Bitcoin traders were left watching from the sidelines. The digital asset, trading at around $87,937, seemed to languish in a tight range, unable to capture the momentum that gold had seized. The reality was stark. While gold thrived, Bitcoin appeared stagnant, raising questions about its identity as digital gold. You might be wondering what this means for the broader market. Even as the US dollar weakened and geopolitical risks heightened, Bitcoin struggled to find its footing. Over the past 12 months, gold has soared over 90%, while Bitcoin's journey felt more like a slow crawl. What does this contrast reveal about the market's expectations? The essence of the discussion comes from James Harris, the CEO of the yield platform Tesseract Group, who expressed a stark realization. We're clearly in a market regime where crypto is underperforming some of the very assets it was designed to supplant. This sentiment resonates deeply. Could it be that Bitcoin's role as a macro hedge is faltering just when it needs to shine the most? As we reflect on this unfolding narrative, we invite you to ponder the implications of these contrasting performances. What does this mean for you as a participant in the market? Where do you see value? In closing, we encourage you to share your thoughts. What insights do you draw from gold's ascent and Bitcoin's struggle? Join the conversation and let us explore the deeper truths of this financial landscape together. Tesla's Bitcoin stance: no changes amidst a $239 million loss. Tesla's Bitcoin holdings remained constant at 11,509 coins, valued at approximately $1 billion as Bitcoin hovers near $89,000. Have you ever wondered how a giant like Tesla navigates the stormy seas of cryptocurrency? You might be surprised to learn that during the fourth quarter of 2025, Tesla's Bitcoin holdings stood unwavering at 11,509 coins. But let's delve deeper. The value of this digital treasure took a significant hit, plummeting from around $114,000 to just $88,000 within those 3 months. This downward spiral forced Tesla to acknowledge an after-tax impairment loss of approximately $239 million on its digital assets, a revelation pulled straight from the company's latest quarterly earnings report. Now, let's journey back to February 2021. Under the bold leadership of Elon Musk, Tesla revealed that it owned a staggering 43,200 Bitcoin, valued at around $1.7 billion at that time. In an attempt to test the liquidity waters, the company sold a small portion, but then, in a twist of fate, lost their nerve and offloaded about 75% of their holdings, just as Bitcoin was teetering at the edge of its 2022 bear market bottom. Since that pivotal moment, Tesla's Bitcoin stash has stabilized, but the question remains: what happens next? As we transition into Tesla's fourth quarter financials, the company reported revenue of $24.9 billion, just shy of the anticipated $25.1 billion. However, adjusted earnings per share of 0.50 exceeded the consensus forecast of 0.45, sparking a slight surge in after-hours trading, up by 3.4%. So, as we reflect on Tesla's recent decisions, we invite you to ponder the implications. What does this mean for the future of Bitcoin and for companies navigating digital asset landscape? Join us in this conversation. Consider how these choices resonate within the broader narrative of sound money and market dynamics. Your insights could illuminate paths we have yet to explore. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Paxos Gold token surges to record highs as investors flee to safe haven amid market turmoil. Tokenized gold is redefining the traditional allure of precious metals, while Bitcoin faces challenges as a risk asset in tumultuous times, according to industry experts. In a landscape where digital asset markets seem stagnant, you might be surprised to learn that crypto investors are flocking to tokenized gold, propelling inflows to Paxos Gold token to unprecedented levels in January. Paxos Gold, known as Paxos, is backed by physical gold securely stored in London's prestigious LBMA vaults. This month alone, it attracted over $248 million in fresh investments, pushing its market capitalization beyond $2.2 billion. This puts Pax just behind another token, known as GOT, which has reached a staggering $5,546.31. But what's driving this surge? Gold is experiencing a remarkable rally, recently crossing $5,300 per ounce. It has skyrocketed 22% just in January and has gained over 90% in the past year. In stark contrast, Bitcoin has experienced a decline of over 10% in the same time frame, leading many to reevaluate their investment strategies. This shift is capturing the attention of crypto investors, many of whom are seeking the stability that blockchain-based gold offers amid an unpredictable economic climate. James Harris, the chief executive officer of the crypto yield platform Tesseract Group, notes that the growing traction of tokenized gold has improved gold's utility, particularly around transferability and divisibility. Tokens like Paxos and ZA allow for fractional ownership of physical gold, simplifying the process of transferring value through blockchain technology. You can now hold a centuries-old store of value without the hassle of traditional vaults. The market for tokenized gold has now surpassed $5.5 billion, reaching an all-time high as both inflows and gold prices continue to elevate the sector. As we reflect on these developments, consider how the nature of value is evolving. Are you ready to explore what this means for the future of your investments? Your thoughts could shape the conversation, so share them with us. What do you think about the rise of tokenized gold in today's market? The Federal Reserve stands firm. What it means for Bitcoin and your financial future. The Federal Reserve's latest decision to maintain interest rates signals a dramatic shift in market expectations, shedding light on the struggles of Bitcoin and the crypto landscape. Imagine a world where the decisions of a single institution can send ripples through markets, shaping the financial future of millions. This is the reality as the Federal Reserve decided to hold interest rates steady, a choice that marks a significant pivot in the narrative surrounding monetary policy. Just a few short months ago, the air buzzed with speculation about a potential rate cut in early 2026. Job gains have remained low, and the unemployment rate has shown some signs of stabilization, the Federal Reserve stated in their policy announcement. Amidst this backdrop, inflation remains a persistent specter, hovering over the economy like a dark cloud. However, not everyone agrees with the decision. Two members of the Federal Reserve dissented, with recent appointees Stephen Miran and Chris Waller, rumored to be a contender for the chair position, advocating for a 25 basis point cut. Their voices add a layer of tension, suggesting that not all is harmonious within the central bank's ranks. As Bitcoin hovered just below $89,500 in response to the Fed's decision, the broader implications for the crypto market began to unfold. U.S. stocks remained relatively unchanged, while the dollar surged after a recent drop. Gold, on the other hand, continued its ascent, reaching near record levels at $5,300 per ounce, highlighting the contrasting fortunes of different assets in this complex financial landscape. Only 2 months prior, the market was rife with uncertainty, with traders grappling over a potential cut that was priced at more than 40%. This uncertainty has now evaporated. As we moved closer to the meeting, the consensus shifted dramatically, with nearly 100% of market participants anticipating no changes to policy. This decisive turn effectively extinguished hopes for any near-term easing, solidifying the belief that the Federal Reserve would maintain a restrictive stance through the first quarter. While the door to early cuts appears closed, the story does not end here. Market participants are not expecting a resumption of cuts at the next meeting in March, with odds from the CME FedWatch tool sitting at a mere 16%. Hopes rise slightly for April, where chances improve to around 30%. The U.S. Federal Reserve's decision to hold interest rates reflects persistent inflation concerns and a stabilizing economic backdrop. This likely results in near-term volatility for crypto markets as liquidity remains supportive, remarked Nick Ruck, director of LVVG Research, in a message shared on Telegram. The question now looms. What will Jerome Powell convey in his post-meeting press conference? Will he adopt a cautious stance, reinforcing a higher-for-longer narrative that could exert pressure on risk assets like Bitcoin? As we contemplate these developments, pause for a moment. What does this mean for you? The landscape of sound money and individual freedom is shifting beneath our feet, revealing both challenges and opportunities. Engage with us, reflect on the implications, and let your thoughts resonate in this evolving conversation. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. The DeFi Awakening. Are risk ratings the key to maturity? In this week's exploration, we delve into the essential role of risk ratings in the DeFi landscape and how they can influence capital deployment on-chain. Welcome, dear viewer, to our insightful conversation on the evolving world of decentralized finance, or DeFi. Today, we're diving into a critical topic: risk ratings and their significance in navigating the complexities of on-chain capital allocation. Have you ever wondered why some DeFi projects seem to flourish while others crash spectacularly? As we observe the landscape, we see a pattern: risks accumulating over time, often ignored until it's too late. Just consider the collapse of Terrazed. Did it fall apart overnight? No. Capital was still flowing in even as the red flags waved. The illusion of stability masked the underlying dangers. Fast forward to November 2025, when USD, a synthetic stablecoin from Stream Finance, lost its peg after a staggering loss of $93 million. There was no sudden trigger. Instead, the risk had quietly built up, waiting for the moment it could no longer be contained. We must shift our perspective. These aren't black swan events. They are manifestations of a deeper systemic issue. DeFi may offer a revolutionary approach to pricing yield, but the necessary information to gauge risk accurately remains elusive. What we truly need is not just data on potential returns, but clarity on the probability of failure. This is where risk ratings come into play, becoming ever more crucial in the deployment of capital on-chain. So, what exactly constitutes a DeFi risk rating? Traditional credit ratings often rely on outdated analyst judgments, leading to catastrophic failures, as seen in Iceland's financial collapse. Many DeFi risk tools echo this flawed model, offering static reports that do little to inform investors effectively. A true DeFi risk rating must adapt to a dynamic environment, continuously evolving with liquidity and market conditions. This is where platforms like Credora shine, refreshing their risk assessments daily. Imagine transforming risk evaluation from a mere snapshot into a real-time pulse that guides your exposure decisions. That's the vision. At Credora, the core metric is the probability of significant loss, or PSL. This innovative measure assesses the annualized risk of losing more than 1% of your principal due to bad debt. Unlike traditional volatility metrics, PSL focuses on tail risks, giving you a clear letter grade from D to A. This simple yet powerful tool empowers investors to make more informed decisions rather than chasing raw yield. Now, let's consider the implications of these risk ratings. They create a common language for investors, allowing them to weigh the yield-to-risk ratio before committing capital. Some may prefer the safety of a grade strategies, while others might venture into higher yield, higher risk territories. The key here is transparency. If the risk of a project like us had been rated as a CC with a 30% probability of loss, many investors might have thought twice, potentially saving billions. Credora's innovative approach measures risk where it truly manifests, using a 3-layer stack that incorporates simulations. It evaluates asset quality, market dynamics, and governance mechanisms, ensuring that risk ratings serve as early warning signals. This proactive approach allows for a more nuanced understanding of yield in relation to risk. As we navigate through protocols like Morpho and Spark, the importance of live, explainable risk profiles becomes clearer. Users can make informed decisions right at the point of capital allocation, increasing the likelihood of successful investments. For risk-aware DeFi to flourish, risk ratings must become standard practice. Imagine wallets and financial platforms allowing users to filter strategies by risk grade, or AI agents guiding decisions based on these ratings. By 2026, we envision a landscape where risk ratings are not just optional, but essential, facilitating the flow of trillions of dollars on-chain, while safeguarding against unnecessary risks. Now, let's shift our focus to Bitcoin. It seems to be struggling to maintain its digital gold narrative amid rising geopolitical tensions. Meanwhile, Ethereum is gearing up for a post-quantum future, and regulators are slowly embracing the crypto space. But what does this mean for Bitcoin? As we've seen, it has some explaining to do. After an early January rally fizzled, traditional assets like gold and silver are outshining Bitcoin. The narrative begins to fracture as institutional interest shifts. Amidst these shifts, we must ask ourselves, what is Bitcoin's value proposition now? The clash between the digital gold image and gold's tangible scarcity is palpable. Can Bitcoin rebuild its narrative without sacrificing its independence? As we contemplate the future, we invite you to reflect with us. How do you perceive the evolving landscape of risk ratings in DeFi? And what does it mean for the future of sound money? Share your thoughts with us, for this conversation is just beginning. Zignum's Bitcoin fund beckons investors with promising yield of over $65 million. Zignum Bank and Starboard Digital have attracted more than $65 million for their innovative Bitcoin investment fund, delivering an impressive 8.9% annualized return in its initial quarter. Swiss digital asset bank Zignum Bank, alongside Starboard Digital, has successfully gathered over 750 Bitcoin, valued at more than $65 million at current market rates, for its Bitcoin investment vehicle. This venture, known as the Bitcoin Alpha Fund, is not just any fund. It is engineered to create yield from Bitcoin holdings without depending on the volatile price increases often associated with cryptocurrency investments. Launched in October of last year and domiciled in the Cayman Islands, this fund reported an 8.9% annualized net return in its first complete quarter. It aims for annual returns between 8 and 10%, meticulously capturing price variances between spot and derivative markets. But what really sets this fund apart? It employs systematic arbitrage strategies, an approach that seizes on pricing discrepancies across different exchanges. This method provides a potential framework for generating steady returns, regardless of the broader market's fluctuations. As we observe the financial landscape, it becomes evident that there is a burgeoning demand among institutional investors for Bitcoin strategies that not only yield income but also preserve long-term exposure. Markus Hemmerli, Zignum's head of portfolio management, emphasizes this shift towards income-generating strategies. The fund is accessible to professional investors in select jurisdictions, including Switzerland and Singapore, opening doors to a wider audience interested in Bitcoin investments. Moreover, shares in the fund come with additional benefits. They are eligible as collateral for Lombard loans through Zignum, providing a unique opportunity for investors to unlock liquidity without relinquishing control over their Bitcoin positions. Earlier this year, Zignum joined forces with the Bitcoin lending startup Debifi to introduce what they claim is the first bank-backed loan platform that allows borrowers to maintain ownership of their Bitcoin. A significant step in the evolution of financial services around digital assets. As we reflect on these developments, we invite you to consider the implications. What does this mean for the future of Bitcoin as a reliable asset class? Let's explore these questions together. Feel free to share your thoughts below. Your perspective could illuminate this fascinating dialogue. Strive's bold move, $100 million surge to boost Bitcoin and slash debt. Strive's latest offering not only attracted overwhelming interest, but also surged beyond its initial goal, raising $225 million. Have you ever witnessed a company maneuvering through a sea of debt, only to emerge with a treasure trove of Bitcoin? That's precisely what Strive, a Bitcoin treasury firm, has accomplished. In a daring move, they successfully raised $225 million through the sale of their SATA preferred stock. The excitement surrounding this offering was palpable. With over $600 million in orders, Strive had to upsize their ambitions from an initial target of $150 million. This overwhelming demand signifies something deeper: investor confidence in the potential of sound money in a world rife with monetary confusion. But what does this mean for Strive? The proceeds from this remarkable offering allowed them to significantly reduce their debt, particularly following their acquisition of Semler Scientific. They managed to retire $110 million of legacy Semler debt, which included the conversion of $90 million in convertible notes into SATA stock. Additionally, they completely repaid a $20 million loan to Coinbase Credit. Now, picture this. Strive stands with 100% of their Bitcoin holdings unencumbered. They are not just surviving, they are thriving. Plans are already in place to eliminate the remaining $10 million of debt by April 2026, ahead of their original timeline. This is not merely a financial maneuver, it is a strategic restoration of freedom through sound money. But wait, there's more. Strive didn't just stop at debt reduction. They took a bold leap and acquired an additional 333 Bitcoin at an average price of $89,851. This move brings their total holdings to an impressive 13,131 Bitcoin, positioning Strive as the 10th largest public corporate holder globally. At Bitcoin's current price of $89,100, this treasure trove is valued at over $1.1 billion, a staggering figure that speaks to the enduring value of sound money. Yet, despite these achievements, Strive shares are facing pressure, dipping by 1.5% early Wednesday to 81 cents. This juxtaposition of triumph and tension invites us to explore the intricate dance of market dynamics and investor sentiment. As you reflect on Strive's journey, consider what it means for the future of sound money in our increasingly complex financial landscape. Are we witnessing the dawn of a new era where Bitcoin and sound monetary principles reclaim their rightful place? Join us in this conversation. What are your thoughts on the implications of Strive's bold moves? Unlocking Bitcoin's potential. Citrea transforms idle assets into dynamic banking. Citrea, backed by founders Fund and Galaxy Ventures, seeks to revolutionize Bitcoin-denominated credit markets with its new mainnet and a treasury-backed stablecoin, poised for seamless US dollar settlements. Imagine a world where your Bitcoin is not just a digital asset sitting idle, but a powerful tool for financial freedom. This is exactly what Citrea, a groundbreaking application platform supported by Peter Thiel's founders Fund and Galaxy Ventures, is striving to achieve. Recently unveiled, their mainnet opens a new frontier, allowing Bitcoin to be utilized directly for lending, trading, and settling in US dollars. But there's more to this story than just technology. Citrea introduces QTUST, a stablecoin fully backed by short-term US Treasury bills and cash. Issued by MoonPay, this token is crafted to comply with the Genius Act framework, ensuring it meets regulatory standards while providing an innovative solution for Bitcoin users. This is not merely a stablecoin. It's a lifeline for those looking to engage in institutional-grade financial activities, anchored securely to Bitcoin. As Citrea positions itself, it reveals a vision where Bitcoin becomes the backbone for liquidity and settlement, free from the constraints of intermediaries. Or wrapped Bitcoin. Co-founder and CEO of Chainway Labs, Orkun Kilik, emphasizes this transformative approach, stating that their mainnet is designed to bring Bitcoin-secured financial activities on-chain, facilitating lending and institutional credit through CTSD. Now, here's where the stakes rise. Citrea has already secured funding amounting to $16,700,000 across 2 rounds, highlighting the growing interest in Bitcoin-focused innovations. As they carve their niche, they join a competitive arena filled with other ambitious projects aiming to maximize Bitcoin's potential. Think about the implications. Instead of letting your Bitcoin gather digital dust, you can now leverage it for lending, transactions, and even stablecoin issuance. What's even more exciting, Citrea claims that over 30 Bitcoin native applications are ready to cater to users seeking diverse financial use cases. This is a clear signal that the landscape is evolving, urging platforms to expand Bitcoin's role beyond mere passive holding. As we reflect on this evolution, consider what it means for your financial future. The shift from passive investment to active participation in the Bitcoin ecosystem is not just a trend, it's a revolution in how we perceive and use money. So, as you ponder the potential of Citrea and its ambitions, what do you think about harnessing your Bitcoin for more than just storage? Share your thoughts below, and let's explore this new frontier together. Bitcoin, the broken promise of digital gold and payment solutions. Your essential insights for January 29th, 2026. By BlockSonic, all times Eastern Time unless indicated otherwise. You may have heard the claim that Bitcoin serves a dual purpose. As a digital token reminiscent of gold with a finite supply of 21 million, and as a decentralized technology enabling seamless money transfer without intermediaries. Yet, here we stand witnessing Bitcoin falter in both roles. As a store of value, it has struggled against traditional precious metals like gold and silver, revealing a narrative of underperformance that many have documented. The situation grows even more concerning when we observe the decline in on-chain activity, reminiscent of levels last seen in mid-2025. For example, the 30-day average of daily confirmed payments processed on the Bitcoin blockchain has plummeted to 748,368, the lowest figure since mid-July. According to blockchain.com, just months prior, we witnessed a peak exceeding 884,000 in September. A payment in this context indicates that recipients receive funds through an on-chain transaction. You might wonder how this decline in activity affects the network. The monthly average of confirmed transactions tells a similar story, highlighting a downturn in network usage. The mempool, or memory pool, where unconfirmed transactions await miner verification, has also stagnated. Currently, it sits with just a few thousand unconfirmed transactions each day, a trend persisting since late 25. On-chain signals indicate a market in consolidation rather than accumulation. Network activity is waning, and this reduced conviction from both institutional and retail investors is evident in the drop in active addresses and transaction volumes, stated Vikram Sabaraj, Chief Executive Officer of Jyotis Exchange. In a recent email, you see, the price of a token is intrinsically linked to the active user adoption of its underlying network. This recent decline in activity offers a partial explanation for Bitcoin's lackluster price performance in recent months. As the leading cryptocurrency by market value, Bitcoin has retreated to $87,500 after reaching highs above $90,000 ahead of the Federal Reserve meeting on Wednesday. The central bank opted to maintain interest rates as anticipated. However, the accompanying policy statement and Chairman Jerome Powell's press conference hinted at a more cautious stance on potential rate cuts in the near future. With Bitcoin's downward trajectory, notable sectors from earlier this week have now plunged into the red. For instance, the CoinDesk Memcoin Index has experienced a decrease of more than 9% over the past 24 hours. Additionally, the Metaverse Select and Culture and Entertainment indexes have both dropped over 5%. In contrast, gold-backed tokens such as Paxos and Zot have seen gains, buoyed by the ongoing rise in spot gold prices. WorldCoin's yield has also surged by 5%. Turning to traditional markets, we observe that oil prices have climbed to 4-month highs across the Atlantic, potentially reigniting inflationary pressures within the global economy. This renewed energy-led inflation could complicate matters for the Federal Reserve in future rate decisions. As we reflect on the evolving narrative surrounding Bitcoin and its role in our financial landscape, we invite you to pause and consider, what does sound money truly mean in this context? We encourage you to share your thoughts and insights with us as we continue to explore the profound implications of these developments together. Crypto markets in turmoil. Major tokens face plunge as caution rules the day. Even with the Federal Reserve's predictable decision to maintain interest rates, rising geopolitical tensions and shifts into safe assets have left crypto traders navigating a stormy sea of losses. In the past 24 hours, bulls have taken a step back as a risk-off sentiment enveloped global markets, pushing Bitcoin down toward $88,000. The Federal Reserve's choice to keep interest rates steady between 3.5% and 3.75% was anticipated. But escalating geopolitical issues and a shift towards safe haven assets have resulted in a drastic downturn for crypto traders. While major stock indices in the United States experienced a mix of optimism and subsequent retreat, with the S&P 500 momentarily breaching 7,000 for the first time, the crypto landscape faced a harsher reality. Those indices are being significantly swayed by earnings reports from the largest corporations this week. However, in the realm of crypto, the aversion to risk was palpable. Bitcoin saw a decline, and the broader CoinDesk 20 index suffered a loss of 2.9%. This flight from cryptocurrencies coincided with gold soaring to record highs, surpassing $5,500 an ounce. As gold-backed tokens like Tether Gold surged amidst aggressive accumulation from Tether and central banks, silver also extended its gains, trading at $117 an ounce. Bitcoin, along with the wider crypto market, continues to behave more like a liquidity-sensitive risk asset rather than a dependable hedge, given its substantial liquidity for investors seeking to exit the sector. The U.S. dollar index fell to a 4-year low this week, yet investors remain skeptical about interpreting this decline as a fundamental shift. Thank you so much for following BlockSonic today. See you soon with more news, analysis, and market alerts. Keep an eye on Bitcoin and continue listening to the sound of the blockchain.